Hello everyone, I'm Yoko. In this channel, I'll share information in English about events happening in China that may not be widely known in other countries. I gather information from various sources and would appreciate your comments on the video content. If you like what you see, please consider subscribing to the channel and showing your support. Today, I want to talk about matters related to Chinese companies. First, let's discuss Chinese joint stock companies. Similar to Japan, these companies have something called capital. Nowadays, Japanese joint stock companies typically have websites where you can find information about their capital. The amount of capital indicates a certain level of credibility, right? Capital is the investment shareholders make when establishing a company. Indeed, the larger the capital, the more assets the company possesses. Therefore, a company with significant capital is generally considered more trustworthy. However, Chinese joint stock companies differ a bit from Japanese ones. In Japan, if a company has a capital of, for example, 10 million yen, that amount must be properly deposited into the company's account. In contrast, in China, they may say, the capital is about this much, when creating a company, and it's okay if the money is not actually deposited at that time. Now, let's get into the main part of today's discussion. The deadline for fulfilling that capital is determined by the individuals establishing the company. Therefore, even if a Chinese joint stock company claims to have a capital of, for example, 100 million, you don't know if that amount has actually been invested in the company. This uncertainty is what makes Chinese joint stock companies a bit worrisome. By the way, in China, even if the capital is decided, there was a system where you didn't actually have to pay it in. For instance, there are companies with a capital of 9,8765,4321, as mentioned in this article. While they are technically required to deposit this amount, in reality, it's approximately 200 trillion yen in Japanese currency, exceeding Japan's national budget. Although they have up to 100 years to deposit the investment, it seems quite challenging. Now, in recent news, due to the absurdity of this situation, China's company law has been amended, effective from July 1st this year. Various provisions have been changed, drawing attention. Among these changes, the deadline for actually depositing the capital into the company is no longer at the discretion of the company but is now specified. Shareholders must now actually invest money into the company. Until now, in China, it was okay not to pay the capital, and many did not. However, under the new rules starting from July 1st, the court will specify the period within which the capital must be paid. This is expected to have a significant impact. Until now, Chinese business leaders could operate their companies without actually putting in money, creating a somewhat risky situation for those dealing with such companies. From the perspective of those engaging in transactions with these companies, this was a rather precarious scenario. When a company declared substantial capital, people might imagine it as a stable and reliable business. However, the sudden bankruptcy could mean the capital was not actually invested, leading to difficulties in debt recovery. While indeed a peculiar situation, it had been functioning within the previous economic environment in China. However, amid the current economic downturn in China, enforcing proper procedures suddenly has placed many business leaders in challenging situations. They cannot inject money into their companies, hence lacking funds even if they wanted to. Consequently, many companies may face elimination. Another suggested measure is to reduce the declared capital to make it appear smaller. Previously, a company might have claimed to have a capital of 10 million yen, but due to a shortage of cash, it might be revised down to 10,000 yen. Such adjustments have become challenging, and it is said that many companies may opt for closure instead. Now, first and foremost, the capital system is designed to protect people dealing with companies. However, the situation was quite lax until now. Ultimately, it seems that the business environment in China relies less on information such as company capital and disclosure, which are supposed to serve as trustworthy information about the company. Instead, transactions in China seem to prioritize not conducting large transactions at once or securing payments through third parties, employing methods different from Japan to ensure the safety of transactions. In essence, the declared capital of Chinese companies may not be as significant as it appears. Currently, the capital system in China itself is being questioned and considered meaningless. Perhaps China is trying to align itself with global standards, but taking such measures during a growth phase might have been more appropriate. Now, with the Chinese economy in decline, demanding companies to properly fulfill their capital requirements could lead to the exit of many companies. Now, I'd like to share another story related to Chinese companies that is gaining attention. It involves issues related to refinancing business loans. To understand this, we need to consider the background situation in China until a few years ago. Purchasing real estate in China was subject to strict scrutiny, aligning with the policies of the government. Under the leadership of the Xi Jinping administration, efforts were made to curb the rapidly expanding real estate bubble. The rationale was to suppress real estate transactions for investment and speculative purposes, anticipating significant consequences if the bubble were to burst. Among various types of regulations, there was one related to regulations when borrowing a home loan from a bank. Essentially, when acquiring real estate for investment purposes, banks were reluctant to lend money. This led to a scheme where individuals borrowed money from banks under the guise of business funds and used that money to purchase real estate. This practice became quite prevalent. Furthermore, in some cases, the interest rates for business loans were lower than those for housing loans. This was because the Chinese economy had been facing a downturn even before the COVID-19 pandemic. To stimulate industries, banks offered low-interest loans, and individuals took advantage of this by borrowing funds ostensibly for business purposes and investing them in real estate. However, a significant difference between housing loans and business loans was the loan duration, with housing loans extending over decades, while business loans, in China, ranged from 1 to a maximum of 5 years. This strategy allowed individuals to continually refinance their loans, sometimes even extending the repayment period by a year without actually repaying the principal. The belief was that as long as the real estate value did not decline significantly, they still had assets. Banks, aware of this, often turned a blind eye, as they were receiving interest payments. However, starting from last year, real estate prices in China have been clearly declining, changing the dynamics of this scheme. In that case, the funds borrowed under the guise of a business loan might have been invested in real estate, and there's a significant possibility of losses occurring. If quick action is taken, there might be a chance to recover, but there are many loans out there that could become irrecoverable if left unattended. The situation is such that banks are reportedly likely to resist refinancing. As mentioned earlier, commercial loans in China typically have a duration of around 1 to 5 years. So, considering that the decline in real estate prices became evident just about a year ago, and with uncertainties remaining due to the lingering effects of the pandemic, the hope for economic recovery has crumbled. The prognosis is that commercial loans, when their deadlines approach, will likely face demands from banks to repay promptly. By the way, if funds borrowed under the guise of a business loan were used for purposes like purchasing condominiums, it could lead to legal issues and might be considered fraud. In such cases, the position of the borrower becomes extremely weak. Therefore, even if individuals have various debts, settling this particular debt becomes a top priority. If that happens, the only option might be to sell the real estate at the purchase price, assuming it can be sold without a loss. However, there's a growing number of reports suggesting that such sales are already happening quite frequently, making it challenging to escape the situation unscathed. In this challenging situation, individuals burdened with debt may have no choice but to quickly sell their properties, potentially contributing to a further decline in real estate prices. This phenomenon is already observable, particularly in southern China, various regions of Guangdong province. As the refinancing period for commercial loans progresses, the trend is expected to continue. In such situations, not only real estate but other assets might also be put up for sale to generate cash. Financial products, jewelry, art pieces, these items could all be liquidated to address the cash flow issues. Therefore, the situation might not only affect real estate but also have a broader impact on various markets, including high-value items like art pieces that experienced a surge in prices during the previous bubble period. This suggests that the market for these items might be significantly influenced in the foreseeable future. That concludes our discussion for today. Until next time.